Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, interest rates have fallen significantly during the past few weeks, but as we come up on the end of the year, let's look back at what has historically been one of the worst years for the 60/40 portfolio in history. Also, mortgage rates, with interest rates moving lower, they have fallen for the third consecutive week. And finally, the consumer has not stopped spending, but they have stopped saving. And that's why we're seeing debt move up significantly. So there's no doubt the 60% equity, 40% fixed income, typically balanced portfolio, the diversification benefits of both equity and fixed income, it's had a rough year. And as interest rates have moved up significantly, we've seen equities concerned about the strong decline in economic growth that many expect over the next few quarters. Also, bonds obviously hurt significantly with the significant drawdown due to the large increase in interest rates by the Fed in response to the highest inflation that we've seen since the 1980s. The 60/40 portfolio has suffered a 25% fall, one of the largest drawdowns since the Great Depression. Now, this large decrease has really weighed on both equities and bonds this year. Now, mortgage rates. Obviously, rates have moved much higher, and we started to see supply, although low, prices have stalled and in some cases are starting to move lower because of these higher mortgage rates. They fell for the third straight week. That's the biggest 3-week decline in 14 years. Of note, the average mortgage rate on a 30-year fixed rate was 6.49%. That's down from about 7.08% on November 10th. This is the largest 3-week decline, in fact, since 2008. So a pretty significant decrease in rates across the board. Finally, we just had the start of the holiday season and consumers are continuing to spend. So that's a positive. But take a look at this. This is the US personal savings rate at 3.1%. That's the lowest level since 2008. If you recall, we talked about this as one of the big tailwinds for the equity markets, this high savings rate in 2021. Well, that's completely reversed course down to 3.1%. And we're seeing the personal savings rate go down, consumer debt starting to go up. The consumer hasn't felt the pain yet, but we are seeing them start to rack up debt, and something to keep in mind as we move into next year. And with that, I want to thank everyone for watching, but we've got an interesting story out of Maryland. 2 people were rescued from a plane that crashed into a transmission tower in Maryland earlier this week. It happened late or mid-evening of Sunday night. They did not get rescued until 2 a.m. the very next morning. 300 plus homes were out with power. They finally got both people out of there. The plane is still stuck. They're still getting it worked on, getting it moved out of there. So fortunate break for them to survive that. And hopefully everybody gets their power back and everything is all right and they get that plane down. But pretty scary, crazy event for those people. Had a weird end to their weekend. With that, I want to thank everyone for watching, and I'll see you next time.